is gold really worth $5,000 an ounce? I mean, even though I'm a believer in gold, as a precious metal created by the gods themselves, this number, it feels different.
It is the question of the day, isn't it? It's on every terminal, every news channel.
It absolutely is. I mean, we're looking at the charts right now. It's Saturday, January 24, 2026, and it just feels like the world has turned upside down. But here's the twist. Here's what I want to throw at you right off the bat.
Okay, let's hear it.
For centuries, for millennia, we've relied on this idea of the geological scarcity of gold. It's been the bedrock of our financial system. But what if that bedrock, what if it's fundamentally flawed?
Flawed.
Yeah, what if there's a new form of capital out there that isn't just scarce in the way a rock is scarce, but is absolutely scarce?
That is the pivotal question. You've nailed it. We're seeing these massive headlines. Everyone's reacting to the price, but there's a structural phase transition happening in the background.
A phase transition. I like that.
And most people are completely missing it because they're just, they're too focused on the $5,000 price tag.
Exactly. And look, we are going to go there today. We're going to dive deep into that. We're talking about Bitcoin, but, and this is the important part, not in the way you're probably used to hearing about it.
Right. This isn't the buy a coffee with crypto conversation.
Not at all. We are not talking about it as a currency for buying coffee. We're talking about it as a thermodynamically superior form of capital, as a base layer for issuing digital credit. And the secret, the thing that makes it all work, is this financial engineering concept called volatility stripping.
Welcome to the deep dive. I'm Satoshi.
And I'm Satoshi. Love that analogy. High voltage. We are absolutely going to unpack all of that. But first, just a quick housekeeping note. Thanks for listening to the show, for doing this deep dive with us. And I have a specific request. Please, if you're getting value out of this, subscribe.
It makes a huge difference.
It really does. On YouTube, YouTube Music, Apple, Spotify, Fountain.fm, wherever you listen. Because every single subscription gets us closer to our goal of 1,000 subscribers. And that threshold, to be totally transparent, that decides if this show stays alive or, goes into oblivion.
We really do appreciate the support. It's what lets us spend the time doing all this research.
It's everything. Also, one more thing. Check out the links to references in the show notes. We've put together a free course on Bitcoin on YouTube. It's a curated selection of some of our best deep dives, and we're pretty sure it'll give you a few new perspectives on Bitcoin. Okay. Housekeeping done. Let's get into it.
Let's dive in.
So set the scene for us. Paint the picture. It's Saturday, January 24, 2026. I'm looking at the data from investing.com right here on my screen. What are we seeing?
Well, if you look at the broad market snapshot, it's what you call a classic risk-off environment. People are scared.
Risk-off. So everyone's running for the exits, looking for safety.
Exactly. And the data shows that flight to safety in the numbers. The gold spot price is hovering around, let's see, $4,982, just under that big number.
So close to the big 5K, I can almost taste it.
Incredibly close. And we actually hit a high today of $4,989.93. I mean, you can practically hear the champagne corks ready to pop.
You really can. And the headlines are just screaming, aren't they? I'm seeing best week since March 2020. It feels like a real moment in time.
It is. And it's not just gold. You have to look at silver, too.
Mm-hmm.
Silver has absolutely vaulted above $100 an ounce.
That is wild. $100. I remember when silver hitting $30 was like a huge deal. Now we're talking triple digits.
It just reflects the broader context that we pulled from our news sources. You're seeing phrases like geopolitical uncertainties everywhere. You're seeing analysts talk about an unhinged debt market.
Unhinged debt market. That sounds comforting.
Doesn't it?
Yeah.
But it's true. There's a sense of systemic fragility everywhere, and capital is doing what it always does in these situations. It's fleeing to what it thinks is safety.
Right. And naturally, that safety has always been gold. It's the shiny yellow rock we've trusted for 5,000 years. But this brings us right to the heart of it, to this gold paradox that was mentioned in our deep dive research. You're arguing that even as the price is skyrocketing, there's a fundamental flaw in gold's actual supply model.
Correct. It all comes down to a really crucial distinction. It's the difference between geological scarcity and absolute scarcity.
Okay, break that down for me.
Gold has geological scarcity. It's hard to find, it's hard to dig up, it's expensive to refine. No one's arguing with that.
Sure.
But it is not absolutely scarce. And this is because it suffers from what economists call the elasticity problem.
Explain that. Elasticity, like a rubber band. It stretches, right?
Exactly. In economics, supply elasticity is just a fancy way of asking,
Yeah.
how much does the supply of something change when its price changes? With gold, the supply is very elastic. Just think about what's happening right this second with gold at $5,000.
Well, if I owned a gold mine, I'd be throwing a massive party.
You'd be throwing a party, and then you'd immediately be calling your operations manager and telling them to fire up every piece of equipment they have. When the price hits 5,000, mines that were previously too expensive to operate, maybe the ore grade was too low or they were too deep or in a difficult location, suddenly become wildly profitable.
I see. So the high price itself is a signal. It's a green light to produce more. It actually unlocks more supply.
Precisely. It triggers a negative feedback loop for the price. The price rises, so miners deploy new, more expensive technology, things like heap leaching or even deep-sea mining, which we're seeing talked about a lot more seriously now.
Right, because the economics suddenly make sense.
The incentive is massive, so they extract more gold. And this increased supply, it eventually hits the market, and what does it do? It dampens the price. It puts a ceiling on it.
So it's a self-correcting mechanism in a way. The higher the price goes, the harder the market works to bring that price back down by just flooding the market with more of the stuff.
Yes, it's a leaky vessel. That's the best analogy. The gold supply inflates by about 1.5% to 2% annually. Now, that sounds really low compared to, say, the US dollar, right?
Yeah, 2% sounds great right now.
It does. But over a century, that compounding inflation is massive. It means gold can never fully capture the economic weight of global productivity increases. Can't be a perfect store of value because the supply keeps expanding to absorb that new value.
It's like trying to fill a bucket that has a small, slow leak in the bottom. You can keep pouring water in, but you're always losing a little bit of pressure. You can never get it completely full.
That is a great way to put it. And this right here, this is where the paradigm shift happens. This is where we have to move from the physics of rocks to the physics of information. We have to talk about the first asset in human history with a perfectly inelastic supply curve. And that's Bitcoin.
The paradigm shift. I love how dramatic that sounds. But, I mean, it really is that dramatic, isn't it? Because Bitcoin just doesn't care about the price.
It doesn't care at all. It's completely indifferent. This is governed by the concept of max money. If the price of Bitcoin goes to $500,000 or $1 million or $10 million, the supply issuance schedule does not change, not one bit.
So walk us through the mechanism there. If gold miners see a high price and they just dig more gold, why don't Bitcoin miners just dig more Bitcoin when the price spikes? What stops them?
One of the most elegant pieces of engineering ever designed, the difficulty adjustment. It's the self-regulating thermostat of the entire Bitcoin network.
A thermostat, okay.
When the price goes up, sure, more miners are incentivized. They turn on their rigs. They point more computing power at the network. They want those rewards.
Makes sense.
But the network protocol sees this massive increase in computing power, and it automatically makes the cryptographic puzzle harder to solve.
So it just balances itself out.
Perfectly. Every 2016 blocks, or roughly every 2 weeks, it adjusts. The result is more security for the network, which is great, but not more coins. The issuance remains locked to the schedule, one block approximately every 10 minutes, no matter what.
So it's the only commodity in the universe where a massive increase in demand cannot trigger any increase in supply.
That is a heavy statement, but it's true. It's the only thing we've ever discovered that works this way.
And we can actually verify this. We can look under the hood and see the proof, right? One of our sources breaks down the actual C++ code in the Bitcoin core software.
Yes, this is what I love. You don't have to trust anyone. You can just look at the code, specifically in the files amount.h and validation.cpp.
I love when we get technical. What does the code actually say?
It's beautiful in its simplicity. There's a constant defined in the code. It says, static constix pre-amount max money is 200 100 00 coin.
It's just written right there, like a law of physics for this digital universe.
That's exactly what it is. It's not a policy target. It's not like the Federal Reserve saying, oh, we're targeting 2% inflation, but maybe we'll do 3% this year if unemployment is high.
Right. It's not a suggestion.
It's a consensus critical sanity check. The code that tens of thousands of nodes run will literally reject any transaction or any block that would result in the creation of coins exceeding that hard limit. It is a law of the system's physics.
But let me play devil's advocate for a second. This is the classic critique I always hear at dinner parties, right? It's just software. It's just code. Can't they just change the code? Can't the developers just delete that line and write in 42 million instead?
It's a fair question. It's probably the most common question, and it gets to the very heart of the difference between code consensus and social consensus. The source material we looked at makes a really interesting comparison here between Bitcoin and Dogecoin.
Oh, Dogecoin, the meme that became a global thing.
Right. And what's fascinating is that Dogecoin initially had a supply cap in its code, just like Bitcoin, it was supposed to be scarce.
I actually didn't know that.
But the community, the social layer, the people running it, they didn't have a rigid ideological commitment to scarcity. Their culture was different. They decided, hey, we want this to be abundant, a fun tipping currency, and so they got together and they altered the code to allow for perpetual inflation.
So they changed the physics of their universe because the social consensus, the belief system was weak or just different?
Exactly, but Bitcoin is different.
Yeah.
The social consensus around the 21 million cap is ossified. It's hardened over more than a decade. It's distributed across tens of thousands of independent node operators all over the globe. If you wanted to change that max money constant, you would have to convince every single one of those node operators to voluntarily download and run your new software.
And since those node operators are, by definition, people who are holding Bitcoin and believe in its scarcity, why on earth would they agree to dilute their own savings?
They wouldn't. It's pure game theory. If you tried to force it, all you would do is create what's called a hard fork. You'd effectively be creating a brand new currency, let's call it Bitcoin inflationary or Bitcoin Core 2X.
And the original Bitcoin would just keep on going.
The original Bitcoin would still exist, chugging along unchanged, with its 21 million coin limit intact, and your new coin would have to compete in the free market, and likely no one would value it.
So for a lender or a long-term investor or a nation-state thinking in centuries, this offers a kind of certainty that gold just can't possibly match.
It's mathematical precision. A lender can know with certainty exactly what percentage of the total supply they hold today, and they know that that percentage will be exactly the same in 100 years. That is the true definition of absolute scarcity.
Okay, so we've established the supply is fixed, it's absolute. But there's another, maybe even bigger problem with gold that I want to touch on. It's what the notes call the epistemology of value.
The cost of truth.
The cost of truth. I love that, which is really just a fancy way of asking, how do we know what we think we have is actually there?
This is a huge, huge problem in the world of high finance and commodities.
Right. If I'm a big central bank and I say I have $1 billion worth of gold sitting in a vault, prove it.
That is the auditability gap. And auditing gold is, to put it mildly, a logistical nightmare. Just imagine you're the auditor for a second. You have to fly to a sovereign jurisdiction, London or New York. You have to get clearance to enter a high-security vault like the Bank of England or the Fed. And then what? You're standing in front of a giant stack of gold bars.
They look shiny. They look heavy.
They do. But are they really gold? Or are they gold-plated tungsten? Tungsten has a very similar density to gold. It's a common way to counterfeit these bars. To truly know, you have to physically drill into the bars or melt them down.
Which is destructive and expensive.
Extremely. So they don't do it very often.
Yeah.
A full, proper physical audit of a major vault might happen once a year, if you're lucky. So for the other 364 days of the year, the entire global market is operating on faith.
On trust.
You are trusting the custodian. You are trusting that the gold hasn't moved or secretly leased out or rehypothecated.
And trust, as we know, is a friction. It's a source of risk. It's inefficient.
It is. Now let's contrast that with the digital audit revolution we see with Bitcoin. There's a simple command line tool mentioned in the research. Bitcoin flank getouts at pinfo.
Gets out at Timfo. Doesn't exactly roll off the tongue.
No, but it's unbelievably powerful. Any user anywhere in the world running a full node on a cheap laptop can type that command in.
And what happens when they do?
Their node scans its own local copy of the entire blockchain, what's called the UTXO set. It sums up the value of every single unspent transaction output in existence.
Yeah.
And it spits out the total supply of Bitcoin in circulation at that exact moment.
Okay, but how long does that take? Days? Weeks?
Minutes. On a decent machine, maybe even seconds.
And the cost to run this global audit?
The marginal cost of the electricity to run your computer, it's effectively zero. And crucially, you don't need permission. You don't need a special badge to get into the Federal Reserve. You just need a laptop and an internet connection.
That's just wild. It's the complete democratization of the audit process. It's radical transparency.
It is the largest synchronized, decentralized audit in human history. Every single node is constantly auditing every other node every 10 minutes, forever.
This has to lead into that concept of triple entry accounting. I feel like I learned about double entry in my accounting 101 class, and that was boring enough.
Right.
What on earth is triple entry?
It's the upgrade. Double entry is the system we've used for centuries, since the Medicis. I have a ledger, my book. You have a ledger, your book. If I send you money, I make a debit on my side, you make a credit on yours.
Right. My books and your books.
But periodically, we have to reconcile. We have to get together and make sure our books match up. And that reconciliation step, that's where all the errors happen. That's where fraud happens. That's where the books get cooked.
Right. Enron style.
Exactly. Triple entry accounting introduces a third shared public entry, the blockchain. We no longer need to reconcile because the blockchain is the single source of truth. If I send you Bitcoin, that transaction is recorded on the public ledger. We both look at the exact same data source. There's nothing to argue about.
So if a bank is holding Bitcoin as collateral for a loan, they can't just pretend it's there in an Excel spreadsheet.
Correct. It's visible. In a proper multi-sig setup, the collateral is locked on chain. It's not in some opaque black box. This innovation could eliminate entire departments of back-office reconciliation and auditing staff. It's a massive efficiency gain.
But what about the paper gold trap? This was a huge part of the reading. It seems like the financial industry has a real love for selling claims to things they don't actually have.
This gets to the core issue of structural integrity. In the gold market, the leverage ratios can be astronomical. Some estimates put it as high as 100 to 1.
Wait, 100 to 1? What does that even mean?
It means that for every one single ounce of real, physical gold sitting in a vault in London or New York, there might be 100 paper claims, futures contracts, ETFs, unallocated accounts trading on the exchanges.
100 owners for the same piece of gold. That sounds incredibly dangerous.
It's the definition of fragile. Most people who think they own gold actually hold these unallocated accounts. And what that legally means is that you are an unsecured creditor to the bank. You are not an owner of the gold. You have a claim on the bank's general pile of gold. If there's a run on the bank, if everyone shows up and asks for their physical metal at the same time, the system completely collapses. There simply isn't enough metal to go around.
It's a giant game of musical chairs, and there's 100 people dancing around a single chair.
That's the perfect analogy. And when the music stops, 99 people are left with nothing. Now, Bitcoin solves this problem with what we're calling the glass vault. This directly attacks the problem of rehypothecation.
Rehypothecation, which is the fancy term for pledging the same piece of collateral for multiple loans, right? It's standard practice on Wall Street.
It is. But with Bitcoin, we have this cryptographic tool called proof of reserves. An institution can prove two things with mathematical certainty. First is proof of assets. They can sign a message with their private keys to prove they actually control the coins they claim to hold.
Okay, so that's proof they have the money.
And second is proof of liabilities. They use a clever data structure called a Merkle tree that allows every single user to independently verify that their specific account balance is included in the company's total liabilities.
So I don't just have to trust them. I can actually go in and verify that my Bitcoin is included in their reserve calculation.
Yes, and because of the UPXO model, the unspent transaction output model, you literally cannot print a paper Bitcoin on the main chain. A UTXO, a piece of Bitcoin, either exists or it doesn't.
It's binary. It's a 1 or a 0.
It is. And crucially, think about this from a borrower's perspective. If you've posted Bitcoin as collateral, you can watch that specific address on the blockchain 24/7. If the bank or lender tries to move your collateral, say, to lend it out to a hedge fund to make some extra yield on the side, you see it happen instantly, in real time.
The alarm bells go off immediately.
You can declare a breach of contract the moment it happens. It's a true glass vault. You can't look inside a JP Morgan gold vault from your living room couch. You can look inside any Bitcoin address.
That level of transparency is a complete game changer. But okay, let's shift gears a bit. We've talked about the scarcity and the auditing. Now I want to talk about energy. We have this really cool concept in the notes, the thermodynamics of money.
This is one of my favorite mental models. It just clicks.
Mine too. The core analogy is that money is a battery.
Right. Think about what money really is. It's stored economic energy. It's stored work. You work hard today, you get paid, and you want to save that purchasing power to use 10 years from now. You need a battery to store that value through time.
And fiat currency, like the dollar.
Is a leaking battery.
Yeah.
Inflation is entropy. It's the energy slowly, or sometimes quickly, draining out of your battery over time.
And gold, where does that fit in?
Gold is a pretty decent battery. It holds its charge relatively well over long periods, but it's a really heavy battery. It has high impedance. It's hard to move. If I want to send my stored energy to someone in Singapore, shipping gold bars is slow, cumbersome, and extremely expensive. There's a lot of resistance.
Okay, so then Bitcoin.
Bitcoin is a superconductor. It stores energy without any loss because of that absolutely fixed supply we talked about, and it transmits that energy without any resistance. You can move $1 billion of value, $1 billion of stored economic energy, anywhere in the world at the speed of the internet for a few dollars.
That's a powerful idea. And that brings us to the apex asset theory.
The theory, in a nutshell, is that Bitcoin is a thermodynamic sink. It's the most efficient battery we've ever found, so it's naturally absorbing the monetary premium from other less efficient assets.
What do you mean by monetary premium?
For decades, people bought beachfront real estate, not just because they wanted to live there, but as a way to store value. They bought fine art, they bought gold. A huge portion of the value of those assets is just this monetary premium. As Bitcoin proves itself to be the superior battery, that energy, that value, flows out of real estate and gold and art and into Bitcoin.
But, and here's the big but that everyone always brings up, it is so volatile. I mean, look at the charts any given day. It crashes, it pumps, it's a roller coaster. How can something that volatile be a good battery, a good store of value?
This is the key insight, and it's counterintuitive. Volatility is not a bug. It is the release valve.
The release valve.
Yes. Remember that perfectly vertical inelastic supply curve. In the gold market, if there's a huge spike in demand, what happens? The supply increases a bit to absorb that shock and dampen the price movement. In Bitcoin, the supply cannot change. It's fixed. So all of that demand shock must be expressed through the price. It's the only variable that can move. If global adoption doubles overnight, the price must double to accommodate it.
So you're saying massive growth requires massive volatility. It's a feature of the adoption process.
It is a mathematical necessity. If you're going from a market capitalization of zero to, hypothetically, tens of trillions of dollars, the path cannot possibly be a smooth, straight line.
Yeah.
It has to be volatile.
Okay, so we have this high energy, high voltage, volatile asset, but businesses can't run on that kind of volatility. I can't pay my rent or my employees with an asset that might drop 10% tomorrow. This is where we finally get to the volatility stripping concept. This is the part that really blew my mind.
This is the bridge. This is the crucial piece of financial engineering that connects the wild, volatile world of the Bitcoin base layer to the stable world of credit that the real economy needs.
And the analogy that keeps coming up here is from electrical engineering. It's called the flyback converter.
Right, and I am definitely not an electrical engineer, but the concept is very intuitive. Imagine Bitcoin is your input power source. It's like raw mains power coming out of the wall or a high voltage line. It fluctuates, it's spiky, it's dangerous if you try to plug your toaster directly into it.
Yeah, you'd burn the toast. And probably the house down.
Exactly. So what do? You need a transformer. In finance, the transformer is the institution's balance sheet. It's the thing that's strong enough to hold this high voltage asset. Then you need a regulator.
And that's the specific financial instrument they use.
Yes. And the goal of all this is to produce a stable output, a smooth, consistent voltage. That's the staple credit, or the predictable yield.
So this is all great in theory, but how do they actually do this? What are the practical ways you strip the volatility out of Bitcoin?
There are three main methods that our research highlighted. The first, and maybe the most famous, is the convertible debt model. This was really pioneered by MicroStrategy.
Ah, the Michael Saylor playbook.
The very same. Think about how a convertible bond works. It cleverly splits the investor pool into two distinct groups with different risk appetites. Group A wants safety. They're the bondholders. They lend money to the company and get a very low interest rate, say 1% or even less. But they get their principal back. They get the consistent voltage.
They're safe. They don't really care if Bitcoin crashes as long as the company itself doesn't go bankrupt.
Right. But you have to ask, why would any investor accept such a ridiculously low yield? It's because of the sweetener. They have an option, but not an obligation, to convert that bond into the company's stock if the price goes up a lot.
Ah, so they get to participate in the upside, but they're protected on the downside.
And who pays for that protection? The shareholders. Group B. They are the equity holders. They are taking on all the leverage. They absorb all the volatility. If Bitcoin drops, the stock drops much harder. If Bitcoin rips, the stock rips much, much harder.
So the volatility is effectively stripped away from the bondholder and transferred entirely to the shareholder.
Perfectly said. The bondholder gets the stable credit they want. The shareholder gets the waste heat, which in a bull market isn't waste at all. It's massive profit.
That makes so much sense. It's an elegant way to split the risk. What's the second method?
The second is the cash and carry trade. This one uses the futures market.
Okay, this one sounds a bit more technical.
It's simpler than it sounds, I promise. All you do is you buy one Bitcoin on the spot market, so you're holding the actual asset. At the exact same time, you sell a futures contract for one Bitcoin that expires in, say, 3 months.
So you are long the asset and short a derivative on the asset at the same time.
Yes. So think about what happens. If the price of Bitcoin goes up by $1,000, your spot holding makes you $1,000, but your short futures position loses you $1,000.
So they just cancel each other out. Your net position is zero.
The price volatility is completely gone. You are totally market neutral. But here's the trick. In a bull market, futures contracts usually trade at a premium to the spot price. So maybe spot Bitcoin is $50,000, but the 3-month future is trading at $55,000.
Ah, so you capture that spread between the two.
You lock in that $5,000 difference, guaranteed. It becomes a risk-free yield. You have successfully turned a volatile, non-yielding asset into a synthetic US dollar that yields 10 or 15%.
That is just genius. You're basically using the market's own desire for leverage to pay you a safe yield.
And the third method is the most straightforward: automated LTV management. This is for direct lending platforms. If you take a loan against your Bitcoin collateral, you might only be able to borrow 50% of its value, a 50% loan to value.
Right, so there's a big buffer.
That 50% buffer is there to absorb the volatility.
And what happens if the price drops enough to eat into that buffer?
The regulator kicks in. An automated liquidation engine, a bot, sells just a little bit of your collateral to pay down the loan and bring the LTV back to a safe level. And this happens 24/7, 365, instantly. It keeps the loan book solvent at all times.
Which brings us to another huge advantage that Bitcoin has over an asset like gold: velocity.
Speed is everything in modern finance.
Yeah, the outline for this deep dive mentions a paper titled The Velocity Mismatch, and it argues that the internet right now, the way it's structured, feels like a slop factory.
Slop factory. It's a very evocative term, isn't it? But it's also disturbingly accurate.
So why is it slop? What's the core problem?
It's a physics problem. It's a mismatch in speeds. Information on the internet travels at the speed of light through fiber optic cables. I can send you an email or a video across the world instantly. So information velocity is speed of light.
Okay, speed of light.
But value, money, it travels at the speed of banks.
Which is decidedly not the speed of light.
It's T+2 settlement for a stock trade. It's a credit card transaction that gets approved in seconds, but takes days to actually settle, and it costs 3%. So the velocity of value, V, is much, much, much less than silver.
So because we can't send tiny amounts of value instantly and cheaply, we have to rely on what?
The ad model, the attention economy. Since I can't easily and instantly pay you 1/100th of a cent to read your article, the publisher has to find another way to monetize my visit. They have to monetize my attention. They have to show me an ad.
And to get me to look at that ad, you need my eyeballs. And to get my eyeballs, you need clickbait.
You need rage bait, you need SEO spam, you need endless listicles, you need slop. The incentive structure of the modern internet isn't to provide value. It's to harvest attention.
So the argument here is that if we fix the money, if we can make value move as fast as information, we can actually fix the internet.
If value becomes a native packet type of the internet, just like data, the entire incentive structure flips. Just imagine if sending an email cost a tiny fraction of a cent, say 0.0001 cents, settled instantly over something like the Lightning Network.
It's completely negligible for me as a regular user. It's basically free.
But for a spammer trying to send 100 million emails.
Oh, wow. That suddenly gets very expensive very fast.
Exactly. Value acts as a filter for truth and a deterrent for noise. It dramatically increases the signal-to-noise ratio of the entire internet.
And this ties directly back to settlement speed. The notes mention the teleportation of collateral. That sounds like science fiction.
Think about gold settlement. The standard is Loco London, which is T+2, 2 business days. If you actually want physical delivery of your bars, it can take weeks. You need appointments, armored trucks.
The guys with guns. Don't forget the guys with guns.
Right. Bitcoin offers probabilistic finality in about 10 minutes and what we call economic finality in about an hour.
Meaning that after an hour, for all practical purposes, it is impossible to reverse that transaction. It is set in stone.
Correct. So what does that mean? It means I can move $1 billion of pristine collateral from a wallet in Tokyo to a wallet in New York on a Sunday at 3 o'clock in the morning for a $5 network fee.
That is effectively teleportation.
It is. And for a global financial system that operates 24/7, that kind of liquidity is a form of safety. If a financial crisis starts to brew on a Friday night, the gold markets are closed. You're stuck until Monday. The Bitcoin markets are always open. You can liquidate, you can move collateral, you can stay solvent.
It's the fundamental difference between an analog 9-to-5 system and a truly digital native internet system.
We are witnessing the upgrade in real time.
Yeah.
From analog capital gold to digital capital Bitcoin.
So let's try to wrap this all up. Let's unpack what this means for you, the listener. We've covered a ton of ground here. The fake scarcity of gold versus the absolute scarcity of Bitcoin, the auditability gap, this idea of volatility stripping.
It's a lot to take in, I know.
Yeah, it is. But the mission here, the key takeaway, seems to be that institutions, and maybe even individuals, need to fundamentally rethink their portfolio and how they think about assets.
I think the summary is this. Institutions should hold the apex asset, which we're arguing is Bitcoin because it's the thing that best captures monetary premium over the long term. But they should use these volatility stripping techniques to issue stable credit against it. You get the store of value properties of the hardest money ever created, combined with the stable medium of exchange properties that commerce and society need to function.
It's really like having your cake and eating it too.
In a way, yes. It's using brilliant financial engineering to create a solution that gives you the best properties of both worlds.
So here's the final provocative thought I want to leave with everyone listening. We're sitting here in January 2026. Gold is knocking on the door of $5,000. Bitcoin is doing its volatile but steady adoption dance. Are we on the cusp of a totally new financial architecture?
That is the multi-trillion-dollar question. If value can finally move at the speed of information, what happens next? Does the slop of the internet start to disappear? Do we move from an attention economy to a true value economy? Imagine a world where you're paid instantly for your data, for your content, where a micropayment can unlock an article instead of an ad, where it's economically expensive to lie and to spam. That's a fundamentally different, and I would argue better, world.
A value economy. I really like the sound of that.
It might be optimistic, but the physics and the engineering seem to support it.
Well, we want to know what you think. As you're listening to this, what's going through your head? Are we being way too optimistic? Is this $5,000 gold price the top, or is it just the beginning of the real collapse of fiat currencies? And hey, we really want to hear from the finance experts and the crypto natives in our audience. If we got the mechanics of volatility stripping wrong, or if you have a better analogy than a flyback converter, let us know in the comments.
Absolutely. This is a community effort. This is a conversation. We're learning right alongside you.
That's right. So check the show notes for all those links and sources. Please subscribe if you haven't already. And as always,
Keep searching.
keep the quest on.
I'm Satosha.
And I'm Satoshi.